December 2025. Two cities, two central banks, one defining moment for the global economy. The world has spent the last 3 years fighting the inflation dragon. Now, as the year closes, the Federal Reserve and the European Central Bank stand at a critical fork in the road. Their decisions this month aren't just about interest rates for the next 6 weeks. They are the blueprints that will construct the economic reality of 2026. For years, their paths have been parallel, hike, hike, hike. But December 2025 marks the start of the Great Divergence. Why are they splitting up? What does it mean for your money, your job, and the global financial system? Welcome to the definitive breakdown of the most consequential central bank meetings of the year. To understand the Fed's dilemma, you have to look at the American economy in late 2025. It is surprisingly, stubbornly resilient. Despite the most aggressive hiking cycle in 40 years, the U.S. consumer hasn't cracked. The economy is cooling, but it's certainly not freezing. But this strength comes with a cost. Inflation is no longer falling like a stone. It's stuck. Core inflation, especially in services like housing and insurance, refuses to drop below 3%. The labor market is the fuel. Unemployment is still historically low, and wages are growing fast enough to keep purchasing power alive, sustaining that sticky inflation. This reality has trapped Jerome Powell in his own rhetoric. He promised higher for longer to ensure inflation is dead. Cutting rates now, with the economy still running hot, risks reigniting the inflation bonfire he just spent 3 years trying to put out. Cross the Atlantic, and the picture couldn't be more different. The Eurozone economy isn't resilient, it's practically comatose. The region has skirted a technical recession for most of 2025. Germany, the industrial engine, is sputtering. Growth is stagnant. Because the economy is so weak, inflation here is falling much faster. The massive energy shock of previous years has unwound, bringing headline numbers down rapidly. Christine Lagarde faces a very different nightmare than Powell. It's not overheating, it's the risk of over-tightening into a downturn. The ECB's rate hikes have done their job, perhaps too well. Credit has dried up, investment has stalled, and the risk shifts from high prices to economic contraction. So, as they head into their December meetings, the Fed is fighting a fire that won't go out, while the ECB is worried about freezing to death. Let's project the Fed's move first. All data points to one outcome in December, a hawkish hold. They will keep rates at their peak. Powell will likely take the podium and deliver a tough message. He'll say the progress on inflation has stalled, and that the risks of cutting too soon outweigh the risks of waiting. The real news will be in the dot plot. Watch for the Fed officials to signal fewer rate cuts for 2026 than the market is currently pricing in. This will be a cold shower for investors hopping for an early Christmas present. The message will be clear: pain is still part of the plan. Furthermore, they will confirm that quantitative tightening, the silent draining of liquidity from the financial system, continues on autopilot. The Fed's December strategy is a defensive castle. They are digging in, waiting for the lagging effects of past hikes to finally crack the labor market. Now to Frankfurt. The ECB's meeting will have a very different tone. We anticipate a dovish pivot. While they might hold rates steady one last time, the language will change dramatically. They will signal that the hiking cycle is officially over. Lagarde will emphasize the rapid fall in inflation and the deteriorating growth outlook. She will lay the groundwork for the first rate cut in early 2026. European bond markets will cheer this. Yields will fall as investors realize the period of maximum monetary pain is behind them. Watch for hints about ending their own balance sheet reduction sooner than expected. They need to stop draining liquidity from a system that is already parched. December is when the ECB officially acknowledges that The risk of killing the economy has become greater than the risk of inflation staying high. These two different December decisions will have an immediate and violent impact on one specific market: currencies. A hawkish Fed and a dovish ECB is the perfect recipe for a stronger US dollar and a weaker euro. The interest rate differential will widen. Global capital acts like water. It flows to where the yield is highest. Investors will sell euros to buy dollars to park their cash in higher-yielding US assets. For Europe, this is a double-edged sword. A weaker euro helps exporters, making German cars and French wine cheaper for the rest of the world. But it also imports inflation. Since global commodities like oil are priced in dollars, a weak euro makes energy more expensive for European consumers again. This complicates Lagarde's job. She wants to cut rates to help growth, but crashing the currency could undo her progress on inflation. So, how do these December decisions shape the narrative for 2026? Let's start with the US. The base case is still the elusive, soft landing. The Fed's plan is that by holding rates high through the first half of 2026, they can gently squeeze the last bit of inflation out of the system without causing a crash. The market expects the first Fed cut around June or July 2026, not because of a crisis, but a normalization cut because inflation has finally been tamed. In this scenario, the U.S. consumer bends but doesn't break. Spending slows, wage growth moderates, and the economy settles into a sluggish but stable growth path. For investors, this is a Goldilocks scenario, not too hot, not too cold. It supports stock valuations, even if the explosive gains of the past are over. But this is a fragile path. It relies on everything going perfectly right. History suggests that when the Fed tightens this much, something usually breaks. The forecast for the Eurozone in 2026 is far gloomier. The risk here isn't a recession, it's something more permanent: Japanification. This is a scenario of chronic stagnation, low growth, low inflation, and near zero interest rates stretching out for years, just like Japan experienced. Driven by fear of this outcome, the ECB will likely cut rates aggressively in the first half of 2026, moving much faster than the Fed. But the problem is structural. Even with lower rates, if banks are scared and businesses see no growth, credit won't flow. You can lead a horse to water, but you can't make it drink. Unlike the US, European governments are constrained by fiscal rules. They can't just spend their way out of this hole with massive stimulus packages. Combined with an aging population and an energy disadvantage, Europe faces a long, hard winter of economic discontent in 2026. Why is this divergence happening now? It's not just about different business cycles. It's about deep, structural changes in the global economy. First, energy. The U.S. is now the world's largest energy producer. It is largely insulated from global energy shocks. Europe has permanently lost its cheap energy supply from Russia. Its industrial base is structurally uncompetitive compared to the U.S. Second, fiscal policy. The U.S. government continues to run massive deficits, pumping demand into the economy. Europe is returning to fiscal rules and austerity. Third, innovation. The U.S. is leading the AI revolution, driving productivity and investment. Europe is lagging in tech and focused on regulation. These aren't temporary differences. They are tectonic shifts that ensure the Fed and the ECB will be operating from different playbooks for years to come. The path for 2026 is paved with risks. What if the central banks get it wrong? Let's look at the U.S. policy mistake scenario. The biggest risk for the Fed is the lag effect. Monetary policy takes 12 to 18 months to fully hit the economy. By holding rates high in December 2025, they might be tightening into an economy that is already cracking beneath the surface. The data just hasn't shown it yet. We could see a sudden financial accident in 2026, a wave of commercial real estate defaults, or another banking tremor, caused by the prolonged pressure of high rates. If this happens, the soft landing turns into a hard crash. The Fed would be forced to panic cut rates, destroying their credibility. The danger of higher for longer is that you eventually break something you can't easily fix. The European policy mistake is the opposite, doing too little too late. By waiting until December 2025 to pivot, the ECB may have already allowed deflationary psychology to set in. When people think prices will be lower tomorrow, they stop spending today. This creates a doom loop of falling demand and falling prices. The other risk is financial fragmentation. As the economy weakens, investors get nervous about the debt of weaker countries like Italy. If bond spreads blow out, the ECB will be forced to intervene with emergency measures, admitting their policy framework has failed. The risk for Europe isn't just a recession, it's a lost decade of economic stagnation. So, how do you invest in a world of divergence? Let's start with fixed income, the asset class most directly affected by these decisions. In 2026, the trade is clear. Buy Europe, sell the US. European bonds will rally, yields fall as the ECB cuts rates aggressively. Investors will lock in current yields in Europe before they disappear, driving up bond prices. In the US, the short end of the bond market, cash, T-bills, remains attractive due to high rates, but long-term bonds are risky if inflation proves stickier than expected. We will see a tale of two yield curves. The US curve may remain inverted, a recession signal for longer, while Europe's curve steepens as short-term rates collapse. The fixed income playbook for 2026 is defined by the Atlantic divide. Now equities. The stock market hates uncertainty, and 2026 will be full of it. The divergence favors US stocks over European ones. A stronger US economy and the AI boom provide a better earnings backdrop for American companies. High interest rates hurt valuations, but massive cash piles and growth potential insulate US big tech. They remain the global flight to safety, trade, and equities. European stocks face a double whammy: a stagnant local economy and a strong euro hurting their exports if the ECB doesn't cut fast enough. In both regions, expect a rotation towards defensive sectors. As growth slows in 2026, companies with stable, predictable earnings will command a premium. The equity map for 2026 still points to Wall Street over Frankfurt, despite the valuation differences. What about everything else? Real estate, commodities, and the rest of the world. U.S. commercial real estate remains a danger zone. Higher for longer means the wall of refinancing debt in 2026 will be painful. Stay away. Gold remains a crucial hedge. It performs well when central banks pivot, and it protects against the risk of a policy mistake or geopolitical shock. Emerging markets are in a tough spot. A strong U.S. dollar usually crushes them by making their dollar-denominated debt more expensive. However, some emerging economies have already beaten inflation and started cutting rates. Selective opportunities exist, but it's a dangerous game until the Fed officially turns. In 2026, diversification is more than a buzzword. It's a survival tactic. No economic forecast is complete without considering the known unknowns. Geopolitics. An escalation in global conflicts could trigger another energy shock. This would hurt Europe far more than the US, exacerbating the divergence. The trend toward protectionism and friendshoring is inflationary. It increases costs and reduces global efficiency, making the central bank's jobs even harder. U.S. domestic politics also play a role. Fiscal spending could become a political football, creating uncertainty about the path of the U.S. debt and economy. In Europe, political fragmentation makes it harder to respond to crises. A weak economy fuels populist movements that threaten EU cohesion. These wildcards have the power to render all central bank models useless overnight. As we look back from the vantage point of December 2025, one thing is clear. The era of synchronized global monetary policy is over. For the past 3 years, the Fed and the ECB were fighting the same war with the same weapons. Now, they are fighting different wars on different battlefields. Investors, businesses, and policymakers can no longer look at the developed world as a single block. You must have a U.S. strategy and a separate European strategy. Their December decisions are the declaration of independence. The Fed is choosing to risk a recession to kill inflation. The ECB is choosing to risk inflation to stop a recession. 2026 will be the year we find out which central bank made the right bet. The stakes couldn't be higher. Both central banks claim to be data-dependent, but in late 2025, this mantra has become a trap. The data they rely on is often backward-looking and subject to massive revisions. They are driving the global economy using a foggy rearview mirror. The Fed is obsessed with lagging labor data that will only show weakness after it's too late. The ECB is obsessed with current inflation data that misses the future deflationary wave. True leadership requires foresight, not just reacting to the last data print. By being purely data-dependent, they guarantee they will always be behind the curve. This reactive approach is the root cause of the policy mistake risks we discussed. It's why 2026 is likely to be a volatile, bumpy ride. Finally, these December meetings implicitly raise the biggest question of all. Is the 2% inflation target dead? Publicly, they will defend it to their last breath. To abandon it now would destroy their credibility. But privately, they know the world has changed. The structural forces of the 2020s, deglobalization, the green transition, aging demographics, are inherently inflationary. The Fed might be forcing a recession to hit a target that is no longer achievable in the New World Order. The ECB might be accepting stagnation for a target that is obsolete. In 2026, we may start to see the quiet acceptance of a higher inflation, new normal. Thank you for watching this deep dive. If you want to stay ahead of these massive macro shifts, subscribe and turn on notifications. Thanks you.